Hey, how's it going, Henry?
Hey, good. Hey, I have a question for you. So I've been noticing a lot lately. So today, um, I mean, like even though, okay, so yesterday the future was red, and this morning it was red like negative point two, negative 2.38, and then when market opened, it shoots up, right?
Mm,
Is it because people are short covering right now in case like there's some bullish news?
hmm. I honestly, I can't see any bullish news on the horizon unless somehow this virus is contained. They actually have the facilities set up as far as the testing sites, kind of like South Korea, how they're doing things, and with the mobile alerts. I like that idea. Um, just in general, I don't see a reason why things should be up. Uh, I would say the only thing that I did notice aside from the bond curve, which is obviously the Fed playing in part, would be a indicator called VVIX
Uh-huh.
that is measuring the volatility of volatility. So it's actually showing the degree of which people are buying options on VIX futures. Um, like if you put that into a chart or whatever, and you do some trend lines and try and find a pattern, uh, I would actually say it looks like a bullish consolidation. So I'd
Yeah.
actually think that it's going to go higher from here.
And like I know Ish and I like we like to play ER a lot. So for FedEx, for example, we saw a call spread, right? And I mean FedEx, their guidance, like they stopped guidance, and their report was nothing extraordinary. So for the past 2 days, it's been kind of like flat below 100, and today it shot up. Like a lot of stocks shot up too, like even ERs, I mean like earning report, even if they don't do well, I mean after hour they shoot up. So that was really strange. It's like no matter what, it seems that everything's being purchased just today, and then
Exactly.
tomorrow it's quad Witcher day. So I mean I'm pretty sure there's going to be like a short covering at the end of the day tomorrow, but
Possibly.
still, yeah, yeah, possibly. But I'm like, tomorrow is Friday. I mean, everything just went up today.
See, you're pointing out what I noticed too is like things are so nonsensical and things are moving correlated. So when the market goes up, everything goes up, regardless of what it is, like RAD or Blue Apron. That was one that
Yeah,
I saw that was ridiculous.
exactly.
It didn't make any sense,
And then
but that's
Zoom went up.
opportunity.
Didn't make any sense.
But that's opportunity right there. Seeing those price dislocations that don't make any sense. You know what I mean?
Yeah.
But it's just a matter of how do I utilize time to my benefit to see out my bias? Not necessarily bias, but what I feel is truth.
uh, you can always look for things to blame, and sometimes there's just not an explanation, especially when it comes to earnings. Things move extremely irrationally, and we're very familiar with this, especially during times of volatility, extreme volatility like this. Um, Number one, we're keeping our position smaller for a reason, is because we're a little more uncertain in general. Number two is that the ranges are so unpredictable. One day we're down 12%, the other day we're up. The market's up 0%, but FedEx is up 13%.
Yep.
Uh, what you could blame it on shorts covering. My thing is just the market can't go down 12% every day, and you can't expect everything to fall down exactly like you like it every day. Things like FedEx makes you scratch your head a little bit. I personally held on to my spread because my confidence was in that this is impossible and that it has to come down tomorrow.
There we
Uh,
go.
it's like, it really sucks. We got to watch, but we got to stick to our plan. We got to stay disciplined because there's no reason FedEx should be trading at 110 right now. They suspended their guidance because it was that bad. They couldn't even tell investors, Same thing on Lennar this morning, but it still goes up just because the market is a little irrational. Our special guest, we have famous Dave, or David over here. David, can you hear us? I see you.
Yeah, I can. Can you hear me?
Yes, we can. Awesome. It's so nice to
Dude,
have you. Really appreciate you coming on here today. So David is a former CBOE market maker, and I want to give him the chance to tell us a little bit about his background. So David, it's really nice to meet you. We're going to be having people who are going to be jumping on and off the live webinar. It'll also be recorded today. But I was wondering, hey, could you tell Eagle investors a little bit about your background and just a little bit about yourself? Thanks.
Certainly, and I hope this background isn't too over the top. I was messing around with the software before and putting a little messaging on the back there, and I can't seem to adjust the brightness on my face. So I'm not actually this pale in real life, but anyway, it's been it's been a crazy ride in the last couple days, weeks, and so many times we say, well, the market never does anything really new, but it kind of feels like we're in new territory in a few ways lately here. I was, just to give you a background, I started trading in 1994. I started as a professional. I was never like an amateur to begin with. I started as a runner on the floor of the CBOE and was eventually worked for free as a clerk for a market maker, and then was hired by a market maker firm. Was trained for 12 months in San Francisco, and then came back to the CBOE and was a pit trader there for a little over 10 years. Then I spent a year and then 30-year bond pit at the CBOT. And then I went away from trading for a while. I came back about 4 years ago and started back trading again and got into the VIX. And so I've kind of made a little niche for myself in the VIX. And I have my own little YouTube channel. I got back in contact with all my old buddies. And incidentally, one of my old roommates is the head market maker for the VIX at the CBOE now. Since then, I've been trying to guide people. My whole kind of goal is education. I love teaching people.
Seems like you're a very experienced veteran, and we're really happy to have you on here today. So I want to get into it a little bit. I know you said you found your niche in the VIX. Your buddy is the head market maker at the CBOE on the VIX, which is very interesting. And we'd love to kind of play on that niche today and ask you a few questions, you and Oliver. So just for everybody who's joining on the call here, I'm just going to act as a moderator today, and it's going to be between Oliver and Dave. And so the first question I had for you guys is, can you explain the VIX? So if possible, could you just keep it in simple terms, and we'll start from simple and we'll get more advanced, but what is the VIX, David and Oliver?
So the VIX is it's a number. It came about in the mid 90s. And back then we just kind of thought of it as an indicator. And back then we kind of just thought of it as like the kind of average volatility of the S&P 500. And essentially, that's kind of what it is. It's a sampling of a bunch of option prices in the S&P 500, the SPX, which I like to say about 80% of the money in the world goes through the SPX in one way or another in trading. And essentially, the VIX goes up when people are afraid. And kind of the reason for that is that money managers, the majority of money managers are owning the S&P in some way or another. And when they get afraid about a market downturn, they don't just bail on all the stocks there because they still want to get the dividend income from them. So instead of bailing on all the stocks, they end up buying puts when they're afraid. And when they buy puts, then the VIX goes up. But it's interesting to note the VIX isn't just based on put options; it's also based on call options, and it generally stays in a certain range between like about 10 and 20. But in this crisis, we've seen it just explode to the upside to levels that big crashes in the past, like 87, 2008.
Yeah, no, I completely agree. We're definitely at historic levels of volatility, both in the sense of realized volatility, meaning the actual move is going beyond what is being able to be calculated inside of the curve. I'd say the main thing here that I use is the term structure. It's basically just showing like a strip of different VIX futures options within the market. It's basically just showing, but it's showing it compared to the spot price of VIX, which is based on SPX.
Awesome. Yeah, thanks guys for breaking it down there. So my next question would build off that. You kind of talked about VIX and how it works with put options and also call options a little bit. But what is the current state? Could you elaborate? I know we have the term structure here on the screen now. Could you elaborate a little bit about the current state of VIX futures and also maybe talk a little bit about the VIX futures term structure as well? Thanks.
Sure. You can see the VIX term structure on there. That's VIX Central, which is a website run by a guy named Eli Mintz. And he also is a good follow on Twitter because he'll post his own impressions of the term structure often. And right now, the term structure is in a play. Well, just to break it down, first of all, if you look at the term structure from left to right, you can see the April and the May future from left to right. Those two are the key futures in most of the products we talk about, which would be UVXY, TVIX, SVXY, VXX, and the VIX is a measure of volatility 30 days out. And so to approximate that, we don't have any way of trading the VIX directly. So instead, the closest we can get is using the futures. And so to mirror the VIX's 30-day out time horizon, we have to take an average of the front and 2-month futures. So we just had expiration on yesterday morning. And so all of our products like the ETPs, UVXY, VXX, and TVIX are based mainly on the April future right now, which would be that future, that front future. In addition to that, a thing that's very important about the term structure. Now we have term structures in other products besides the VIX. We have it in oil, we have it in other commodities, we have it in the S&P. And this term structure is what we call both inverted and in backwardation. And it's inverted because the spot price of the VIX is higher up than all the futures. And it is in backwardation because the futures, as you go out in months, slopes down. Typically, we're only in backwardation about 80% of the time. And we've been in backwardation now for about 18 days, which is a relatively long time. Usually, we don't spend much time in it. So this is the slope of the curve between the front and second month futures is the rate at which we're in backwardation. And currently, that's about 12%. And what that means is that the front month future is slowly being replaced by the second month future, which is pulling the average away from the VIX spot price right now. And there's pressure towards expiration pulling upward on both of these futures towards the spot price, and that creates a upward pull. Yeah. So what that is the value of UVXY and TVIX is being pulled upward by about 12% per month right now. And so that's an important feature of this term structure, which we have to take into account when we're trading TVIX or UVXY.
Yep, that's exactly right. That's also why last week when I gave that alert about the futures are getting ready to roll, basically in order for the future month to settle, it has to be pulled up towards the spot pricing, which is right around the $72 mark. Just in general, how that equates to the overall broader market is that's going to make ranges very, very wide. And this is very unusual. Like Dave said, typically we're in this state roughly about 20% of the time. Usually we're in a state opposite of this 80% of the time. When we're in that state where it's opposite of this, it gives us that stair step, slow lagging feeling upward in the market. But when we're in this state where it's inverted, it's kind of like taking the window down. You get what I mean? But yeah, no, it's confusing. How did you do on roll, Dave?
I wasn't playing it all that much because it's just kind of out there. We have all these forces. I know it sounds confusing because it is, and we have all these forces working back and forth with each other. The main one, of course, just being the VIX moving around. But we also have this backwardation contango thing. we've also got the fact that the futures are right now, they're not that much lower than the VIX, but for a while they were like 25 points lower than the VIX. And so it's all very confusing and it's hard to figure out what to do.
A lot of people on the call today and a lot of people who will watch this video do not trade the VIX, but they trade other assets that are probably correlated to the VIX or can be that are related in some regard, such as, they're buying calls, they're buying puts on any kind of U.S. security. What knowledge can we gain from what's currently happening with the VIX? And maybe we want to talk more in general as to if we see the VIX going down or up, what can we expect in the market? And just generally, what can we learn from what happens in the VIX compared to the SPX or the SPY?
Okay.
Well, I think we won't see a sustained rally until the VIX goes lower. I mean, that's pretty much a consensus among my trader friends, at least. It's hard to tell what's going to make that happen, whether it's a policy thing or the U.S. just getting on top of this situation. But the VIX signals to a lot of big traders what. If the market's going to rally or not. And although the VIX is not an indicator, it doesn't indicate ahead of time something that's going to happen. It kind of tells where we are right now. And with it above 70, we're just not going to be able to sustain a rally.
Yeah.
Right.
My
No, I
opinion.
agree. It tells what is the expectation for volatility? Is it expanding or is it contracting? In the current state where it's at, it's definitely still going to stay elevated to expanding. So the reason why I thought this whole interview was very important is because not a lot of us understand why I'm taking sort of like a shits. But basically, since I know the ranges are expanded and they have the probability of expanding further, I'm trying to figure out ways of how can I take advantage of that and how can I use time as my benefit. So the main way that I've been doing that has been through diagonals or calendars or I guess butterflies. It really depends. But the main thing is I just want to make sure people understand certain states demand certain strategies. So you can't always just do one strategy and take the cake.
Well, I mean, there's a number of ways of shorting volatility, and everybody has their favorite way, or buying or selling volatility. Before there were these VIX products, we would just go in and, if volatility gets high, we might use something as a proxy for the market, like your Apple or name your favorite big stock, your Facebook, and we might sell strangles, or we might, if we wanted to gain access to shorting volatility, or we might buy premium. We might pick. Look in a sector and pick a stock and look at the various vol levels of different stocks and pick one that is relatively low if we wanted to kind of buy some volatility at a certain level. So everybody has their favorite. I used to trade UVXY, but it's become so illiquid that I kind of stick to VXX right now. Just for like kind of a little bit of inside baseball for volatility products right now. TVIX and UVXY, a lot of people have started trading them to the long side recently, and they've swelled to a size where they're these big monsters that are threatening to reel out of control for the companies that run them. And so it's a very, this is not a normal time. And, a lot of the strategies that I've outlined in videos in the past are not applicable right now. For example, today we saw on the close utility, all these funds have to rebalance to the downside. And today on the close, we saw people selling futures ahead of the rebalance, knowing that they'd have to rebalance. We saw the futures get just destroyed to the downside. And then right after they rebalanced, we saw them rip back to the upside. So there's a lot of craziness going on out there right now. And, I'm on the sidelines, and I'm a professional. And so that should be a signal to other people to be extremely careful right now with this stuff. When you look out there, you see TVIX, you see a field of red, and you see TVIX up $300, and it's very attractive to jump in, and you see money there. But I caution people to be extremely careful with the volatility products right now. I know I'm not answering your question very well, but it's just kind of a public service announcement while I have a platform here.
Showed me like you got to look into the holdings. That's the thing that people don't do, is they don't look at the holdings. There's a reason why some levered funds like Nugget, JNUG, et cetera, are all going to go basically to the trash bin and get reverse splitted. But the important thing here is we got to know what we're holding and why we're holding it. Yeah, and
Yeah.
same goes for volatility, because this state of volatility is not going to last forever. So it's very much, you got to know what you're holding.
Yeah. Oliver, that's a great point there. I appreciate you bringing that up because that's applicable in all aspects of trading. We got to evaluate the underlying asset there. So a lot of the times people will give me a question, hey, what do you think of my SPY 290 put? Or hey, what about the specific company that I have a call on? You know, I say,
Yeah.
why don't you look at the company and look at what they're actually doing? You know, look at the actual structure of that underlying product and stuff like that. So yeah, it's a very very important question there. And very important answer. Guys, is just general thoughts on the market. So I know we're talking about VIX. Maybe we can relate that to it. But let's talk about like SPX in general, right? Retail investors are starting to notice. You know, you have your doctors and your people with 401ks who are starting to see, oh wait, I'm losing 30% of my entire account. What's going on? You know, they're wondering, hey, where is the bottom? You know, and everybody tells you where the bottom is, they're guessing, you know, but in regards to the VIX, is there anything telling us that a bottom is soon, or maybe there's no bottom in sight? I'm wondering what the VIX is telling us about the current market conditions, and more importantly, what's the forecast in regards to the VIX?
Well, once again, I just have to reiterate that we are at a very extremely elevated level, and that tells me that the market is not, at least in the U.S. You know, when I talk to friends outside the U.S., it's a kind of a different story. But the U.S. market kind of runs the world still, and inside the VIX at this elevated level is just telling me personally that, you know, this is not over yet. It just, at some point we will reach some sort of equilibrium and start heading back up, but it just hasn't happened yet. And that I'm pointing to the fact that we're still in the 70s in the VIX. I mean, we came in a little bit today, but it's up and down, and until we can get a move down, I would say back into the 50s at least, the markets just have not, or is not convinced yet that the U.S. has this situation under control and that we've turned a corner yet. So to me, it's just telling us that, you know, and when I talk to my followers and whatnot, nobody's jumping in and really like buying stocks with both hands or selling a bunch of options. People are still just kind of waiting for this to digest itself, and it will at some point. But it's telling me that this is just not over yet. Yeah.
No, I completely agree. The main thing inside of VIX that we're seeing, let me flip. There's what's expected of the VIX, but then there's also what the VIX is actually doing. And what the VIX is actually doing is far exceeding what is expected. So that's the main part that's concerning. But yes, this situation is dire. You can see it in a lot of different assets. Like I've been harping on this a lot, but the dollar, you can see that a lot of people are just flocking to the dollar, and they're dumping everything humanly possible from a managed money point. I mentioned using the 2008 playbook as far as like when Lehman crashed. One of the main things that happened was that everything got dumped, including gold, or the things that you thought were safe. The things you thought were safe are, I guess this kind of just points out the hubris that we had, because we knew about this virus well in advance, that we thought we were special. I mean, it's not to say that we aren't special, that we're not smart or anything like that. But yeah, no, I guess I mentioned this a while back, but I hate this analogy, but it makes me think of the Game of Thrones. So it kind of goes back to another theory that there are no such thing as black swans. There's something called a dragon king. Basically, what the Dragon King does is he rides on the dragon and he destroys the city. So what we're trying to do and what the economy is trying to do is figure out, are we going in the path of inflation or are we going in the path of deflation? That's something that we're still trying to figure out because we have several shocks going all at once. We have oil. Low oil is not good for the bond market. We've got this demand shock as far as this virus going on, which it hasn't even officially begun yet, and we won't know until about 2 to 3 weeks. That's what's expected. But the main thing here is that after everything is said and done, what they're trying to do is create inflation. So in the end, we know what will happen to assets, but it's just a matter of time till it gets there. And the same goes for VIX. VIX will go down again. Very hard.
Right. Okay, awesome, guys. Thanks so much. So I wanted to throw it over to one of our top traders, Vishu. He had a question for you guys in regards to, I believe, leverage ETFs. Vishu, can you hear us?
Hey, so I was wondering if you could just go into leverage ETFs. I know you briefly touched on TVIX, and could you go into why people don't hold them for the long term and what's happened in the past where you've seen these leverage ETFs fall almost like 98%, 95% within a couple months?
Yeah, David?
Yeah, so leverage VIX ETFs exhibit the same sort of slippage that all leverage ETFs exhibit. So for your NGAS, DGAS, all of these, as they rebalance, they kind of slip. And it's kind of like as they have to rebalance, if you have a 3 times leverage ETF, as it rebalances each three times multiple, they'll buy or sell a bunch of futures. And what ends up happening is if it's way up one day, they're going to buy a bunch of futures. And then if it's way down the next day, they're going to sell those same futures out at a lower price. And that just creates losses. And that's a decay that's that happens in all leverage ETFs. But the big thing that makes VIX apart from those, well, there's 2 main things. One, there's no direct arbitrage between the VIX and the futures. And so usually with the S&P 500 term structure or others, you could, if the futures are way down here and the cash is way up here, you could buy futures and sell baskets of stocks, and enough people do that to bring the relationship back in line. But with the VIX, that doesn't happen. So that's not exactly a slippage thing, but that's a unique characteristic of the VIX. But the second thing is contango. When we are that 80% of the time that we are in contango, that number that you saw on the screen that, and it usually averages around 6 or 7%. Yeah, the contango number on the bottom left of the screen. Right now, it's negative 33% is showing, but that's a different date. But
yeah, I'm trying to get a contango date.
Yeah, that number is decay per month, and it sits around 10% for long periods of time, and 10% decay per month is 100% per year, and that's where you get those big down moves. But we won't see these products decaying again until the chart has flipped itself back around and the spot VIX price is way below the futures again. And I don't see that happening until we get a very big rally. Right now, they're discounted by 6 points for the front month, and the second month is like way more than that. So while we're inverted, we can't see that kind of decay. We could see a down move in the VIX, but not the massive decay. In a down move in the VIX, I don't see us going back to 10 in the VIX anytime soon. I don't see us going back to 20 even for a while. Once this stuff shakes out, we could go back to 40, but it's going to take us a while to take out the all-time lows again in these products, in my opinion.
Yeah, no, just in general, like you was saying, just overall, the market needs to digest. Uh, we are going to experience pain in the overall market, but the important thing is to know why the market is acting the way it is. It's not necessarily why, but how do I cope with that, and how do I, just in general, just deal with it? Like, you got to go with the flow. Don't be the kid playing in traffic, because that's how you get run over.
Yep.
Okay.
Okay, wonderful. Thank you so much, guys. And Vishu, great question. And Oliver, like you said, we got to run with the punches, right?
Yeah.
So next thing we have, so everybody, thank you so much for joining us today. We have about 50 people from around the world on the call. We're here with professional trader and former CBOE market maker, David Lincoln. He's doing a really awesome job speaking to us about the VIX and different kinds of volatility futures and kind of just general outlook on the market. I know this is something that we often do here at Eagle Investors. David, I was reading a little bit about you online, and I saw that in the past when you worked on the floor, you were in charge of bringing liquidity during earnings, specifically selling options during earnings. I think I saw that somewhere. I'm just
having a short options position coming into earnings.
Yeah, like selling like the 2.5 times implied move call out of the money during like for FedEx during the coronavirus, you know?
I would just, I would be careful. I don't feel really comfortable selling, being, when we look at it as a market maker, when we look at options, we don't necessarily always look at calls and puts. We look at unit counts. So if you have a certain strike price, regardless if you're selling a call or a put there, are you short or are you long units? And, I think this market just has a potential to rip really hard in one direction or another. So I don't know. Right now, I am not in favor of selling a bunch of naked calls in anything. I'm just not. Just because we don't know what's going to happen. I was watching Darden earnings this morning, and the DRI, the price action yesterday was just unbelievable volatility. And, I think there's an illusion out there that there's somebody upstairs who's like super smart that like kind of knows what's going on and is like capturing these moves somehow. Whereas the reality is professional traders are just as boggled as everybody else by this stuff. And there's no like super smart person out there that has it all figured out. I think that's one myth you can dispel. And the other myth is just that market makers somehow are, pulling the strings and are manipulating everybody or something. We try to influence price as best we can. And certainly if somebody comes and buys something, I'm going to try to get the price up as high as I can before I sell it. But, we look and we say, the retail says, oh, it's the market makers that are, that are like stealing the money from everybody and know what's going on, and insiders. And the market, we all say, oh, it's those guys upstairs at Goldman that are like manipulating everything and pulling all the strings. So, I think a really important thing to realize about market makers is nobody really knows what's going on. And if they tell you they do, then they're lying or they're naive.
I was wondering if you wanted to talk a little bit about more of the ranges we're seeing and maybe the strategies that we are utilizing. So this is just playing off of what we were just talking about, is that you can buy options or you can sell options or you can do a combination of both. What are the strategies that maybe use a little bit of both, or what's a strategy that is probably the safer one to play out of maybe those three during these current market conditions?
Right. No, it's really complicated, and it kind of goes by feel, I would say. The main ones that I like, because they don't use collateral, are calendars and directional diagonals. And by directional diagonal, I mean, think of like a bull call spread. So you're bullish on volatility, but you're going to split that up into separate months. So you're selling the front month at a higher price, but buying the back month at a different price. So you have to find assets that do well with volatility, for one, expectation of where price is going to go from there. The other one would be like a downside calendar. So for like SPY or UVXY, that's one that I usually used to do, but currently I haven't been doing that in a while because the stove's still hot. But basically, you're selling one month to buy a different month. You're taking on a directional bias, but at the same time, the main goal is to kind of get a coupon. So kind of like, you know, when you go to the store and you're out fighting the hoarders during the zombie apocalypse, trying to buy some toilet paper, and Charmin leaves some coupons in the mail for you. You bring a coupon in and you get your Charmin at a reduced price. That's kind of like the way I think about it, but it's also volatility positive. So it's kind of like a sponge. So volatility is kind of like water. So somebody's splashing water on like a surface or something like that. You need a sponge to soak it up. Both of those plays soak up the volatility. How long is this high volatility going to continue? Your guess is as good as mine.
Mhm. Yeah, and I know we've gone over this in past education webinars, but the simple answer, number one, there's no simple answer. Number two, if you're going to make a simple answer, if anybody's going to tell you where the market's going in the next minute, couple minutes, day, long term, they're guessing, completely guessing. They never know. Nobody knows. We can make educated guesses, and we can, we can create parameters and plans and plays and positions, but nobody, even Goldman Sachs, doesn't know exactly where it's going tomorrow. So awesome. So
Yeah, that's
hey,
exactly
David, I had a
right.
quick question for you. I know you're a very experienced veteran here. I'm always wondering about people's 2008 stories. Specifically, I know one of our moderators here at Eagle Investors. He was a hedge fund trader in 2008, and he was 110% short during the bank bailout, as well as the ban on short selling during 2008. So a lot of questions that we're getting, and we're making a lot of money on put options. People wonder every single day, is there going to be a ban on short selling? Are they going to stop the stock market? I'm wondering where you were in 2008 and what your relationship to that is, and what you think is going to happen. Is it a possibility? Our members are wondering.
Yeah, I actually I was not active in 2008. I was out of the market at that point. I was I was, however, around during the 2000 to 2001 internet bubble burst, which was kind of what it was like we just kind of ground lower, like just every day it was just a little bit lower, A, and B, all the option paper kind of just dried up. And so volatility came in. We didn't rally, but volatility came in just because the market kind of just stopped moving. It stayed down, it stopped moving, and like for a market maker, there was no way to kind of make any money because nobody was putting any paper towards us. Nobody was doing any options trades at all, and so we were just kind of standing there like tumbleweeds rolling through. And so that was a very frustrating situation during that time period. Yeah, and certainly, you hear all these stories. I had friends who were trading during the 87 crash. I had one friend who he slept in during the 87 crash, and he was long a ton of puts, and he became a multimillionaire because of that. This guy Moose in the OEX pit, and he came in and he made a fortune. And I'm sure we'll hear stories about that coming out now. Out of this, there's going to be winners and losers in this whole thing, and certainly some people have made money. I know when you go online and you see very vocal people sounding like they made money, it can be depressing, or it can be frustrating, I would say, when most of us didn't make money during this, and I can speak for retail certainly, because most retail people are in some version of the buy and hold thing. Now, I might be speaking to a little bit more sophisticated people here that have different strategies than that, but the majority of people didn't do well during this thing. So if you didn't do well, you're not alone, and you shouldn't feel like everybody out there is killing them, because it would be foolhardy to be short the market all the time. And those who caught this particular move, that's awesome, and it's awesome they made money. But for people to think that I wouldn't feel bad if you didn't catch a huge win on this, because it's a very tough market out there. So you kind of got to judge it yourself with your own parameters and what your own little situation is, and don't listen to the very vocal people who are saying like, oh, it was so easy, I knew it was going to go this and that, because those people are all out there, we know, and it's not real.
No, I agree. Like, I mean, you just gotta keep that positive momentum, and don't fret on the trades that went bad, but learn from them, practice, reflect, use the tools that we have inside Thinkorswim. I stress it a lot: on demand and think back. Just in this current state, we need to be comfortable being uncomfortable, because Dave, as a market maker, what would you say on the state of liquidity in the market?
Well, there's not a lot, and that's actually a good thing in a way. If you are trading options, I would definitely put some bids and offers out there. If you have a position on in something, I would, if the best thing you can do, the best trade against buying an option is selling that same option out at a better price. And if you put a trade in, I would dangle offers out there, because the markets are so wide right now. You never know when you're going to get filled at good prices. I mean, some of the stuff is like $2-3 wide. I would get in there and put small bids and offers and stuff, and see what happens, because I've been amazed just messing around with 1 and 2 lots, how I've gotten really good fills on stuff. Just to talk about that whole thing, going back to like, if you're not doing well, I would get really small, but I would still be active, and I would do very small stuff. But the lack of liquidity it's bad if you're a market maker and have to make markets. Actually, it's good if it's good for all of us as traders who are smart, because we can put bids and offers very wide and dangle it out there and possibly get filled a lot of the time. So I would see lack of liquidity, which there is now, as an opportunity for you.
I like it. It's kind of like going fishing, right?
Yeah. Yeah, and David, that's actually been very evident. I've actually experienced that recently. I know a lot of our members have. We were playing some spreads on earnings, specifically credit call spreads, credit put spreads. I know we had like a credit call spread on like MongoDB or some different tech companies during this crash, and we put it in our order at somewhere we feel comfortable. Taking about 10% profit, 15% profit. We put in our order of 0.2 on a $2 spread. And we're getting filled at like 0.34, 0.35, and that's never the case, because usually we have to bump it down for a credit trade, instead of up. So that is very interesting. I appreciate you explaining a little bit and justifying, because our members and even myself specifically, we've been experiencing this in the market, and there is an explanation for it. So one super simple question for you, David, is could you explain what a market maker does? Because I know a lot of people will say, he makes the markets. What does that mean? Maybe for the other people out there, what was your job at the CBOE? And then also, in simple terms, what is a market maker?
Right. So things have changed a lot now because everything's electronic. But essentially, a market maker is required to make a two-sided market in a certain size. So you have to say what you'd buy something for and what you'd sell it for. And it has to be relatively tight, value of something. Back in the day, it was, in a sense, it was a great deal, because if you're the only people in the world that are the market in something, then you can set the prices, and it can be sort of a monopoly type situation. And you can, when you know someone's going to buy something, you can raise the prices. When you know they're going to sell it, you can lower it, and so on and so forth. But essentially, you're just providing a bid and an offer on all these products. And so it can be a tough job, because, you don't get to choose your position. My position was always the opposite of whatever people wanted to trade. And usually the people I was trading with were professionals from, once again, your Goldman Sachs or your Morgan Stanley. And I was always left with, like, if you think about the worst position you would want, that's what you're left with as a market maker. And you have to try to figure out how to manage it as best you can. When you have illiquid issues, it can be very difficult. But, if everybody in the world is buying Apple calls, then you're selling Apple calls. And there is some leeway. You can raise the price so much that you just don't have to sell them. But as a market maker, you have a responsibility to keep keep trading. You got to stand there and keep making the market all the time. You're like the casino, and it sounds great. Like, oh, it's, and then sometimes it is great that, somebody comes in and sells you a call for, 50 cents and someone else buys it back for $1 2 seconds later. But the other part of it is just that you get stuck with like the worst positions ever, and you just got to figure out how to get out of it somehow. And so it was a good job to teach me how to trade. It's very different from retail trading where you can pick your position, and but it's about things like price discovery. You move price. If there's buyers, you move prices and you keep moving them until you get a seller. If there's sellers, you try to get the price down as much as you possibly can. As a floor trader, we would at times work together to try to stay in business. But the job of a market maker is to make a two-sided market, and you can control the price and the size at each price level, and that's what you stand there and do all day.
Awesome. And David, where does this money come from as a market maker? So, for example, a frequent guest we have here on the webinars is a former head options trader at a hedge fund in New York City, and he's trading with the fund's money or the bank's money, and being almost a broker when he was at the banks, and then the guy buying it from the banks, during when he was a hedge fund trader. I'm wondering, where does that money come from? You say, I have to it's not always my choice where I get to take a trade as a market maker. I'm wondering who's going to trust you with their money to do something like that.
Right. So you have to have a significant amount of capital to be a market maker. And it essentially involves you talking someone into backing you, convincing somebody to put money behind you to take on this risk. And there's certain hubs in the world like Chicago where there's people that are looking for people to go in and take risk. And basically what we're taught to do is go in and actually take a lot of risk in certain cases. And so the way it works is we have whatever positions we put on, it's determined what our haircut has to be. It's determined how much cash has to be in deposit to support those positions. And for me as a market maker, my haircut range usually didn't get over about $2 million. But I was part of a joint fund of about $40 million for about 10 people. And the capital requirements would change from time to time, but also we had to pay a seat lease, which is kind of like a taxi medallion, which ranged anywhere from $5,000 to $12,000 a month, plus about $3,000 in clerk expenses. It's an expensive thing. Like my nut per year was about $250,000. So I had to make $250,000 before I started making money. But after that, I got to keep 40% of my profits. So, so if you make $1 million in a year, then take 250 off the top for expenses, and then of that 750, then you get to keep 40%. So the deals are not as good nowadays. And nowadays, to be a market maker, it's more about computer skills, because what you would doing is you'd be running computer programs to make the market over a big portfolio of stocks. And so the skills these days are computer skills, and it's a lot different world than it was back in the 90s when you're standing on the floor. When I was making markets at first, we didn't even have we had fractions. So I'd have to go home on a weeknight or a weekend and practice my eighths and quarters doing math quickly, because the person who could do fraction math, like high school math, the fastest, was in control of the trade. Because if you could do the math fast enough, then you could put a best bid in for a broker fastest, because you have to stand there and you have to compete and give a bid to the broker. It's an open outcry system. So you stand there and you have to yell to a broker your bid and offer. And if you have the best bid or offer, then you're in control of that trade. So not only do you have to have your understanding of options and everything, but you have to be fast at math, and you've got to be on it, and you've got to be first out of all these people who are professionals. So it's a unique challenge in an open outcry environment. Now with computers, it's quite different, but the money comes from backers. You have to find, there are people out there who take the risk of backing market makers.
Awesome. David, thank you so much for the answer there.
Yeah.
So just my next question there, I think this will be our final question for you, David. I don't want to keep you too long here, but what we'll probably do is we'll stay on here. I know we have about 60 people now, so I'm planning to stay on here. So if you guys have a question, just throw it in the either the Discord chat or you can throw it in the Zoom chat as well. But David, my question for you is you were just talking about how it's changed a lot since when you were a market maker, specifically in regards to computer skills and technology. So as we continue to evolve as a human race, technology is becoming more and more advanced. So I'm wondering, what do you foresee technology's role being in the markets? Specifically, people will say, oh, there's algorithms that are doing buying and selling and they're making people money while they are on the beach. Is this a real thing? Do you see this is where the market's going? Will there always be an opportunity for a human in the market? I'm just wondering your opinion on the future of technology and markets.
Well, it's a big philosophical debate, isn't it? I mean,
It is.
and I get into it with people all the time. Some believe that computers are controlling most of what's going on right now, and algorithms are controlling most of what's going on. Side of the argument that everything is still led by human emotion, and when we see these big moves, people are not trusting, in the end, people are not trusting algorithms with the big decisions out there with trading. I have a friend who is a very big VIX trader, and he turned his algorithm off a couple months ago just because it wasn't working, and tried some other stuff. But I think computers are taking over things in a big extent, but it's still humans that are making the big decisions out there, in my opinion. But people will debate me on this, and there's no, I don't think, right answer, really.
Right.
I don't know. What do you guys think?
Yeah, David, that's a great question. So I was watching a video, on YouTube one night. It's like technology in Wall Street and how robots have taken over Wall Street, and they showed the basement of the New York Stock Exchange. And I believe you can rent space there for your algorithm or your hard drive or whatever it may be to get the most high frequency information as possible directly from the exchange, the closest place in the entire world to your supercomputer. So there are things like this that exist. It doesn't mean that retail traders and retail investors cannot make money. And I'm sure, our members have realized that. But it's definitely interesting, and it's a philosophical debate as a whole. But we just got to make sure we don't let the robots go a little haywire, too much, and we got to make sure we can keep a handle on it. That's my only concern with it, in my opinion. But and David, one thing I wanted to say as part of our 3 Steps to Profit program that we have here at Eagle Investors is we have an options chain software where you can input it's the options chain, and what you can do is you can input your target stock price and your confidence level, and it will first of all, it shades options that are too far out of the money where the risk and reward doesn't make sense. And then second of all, depending on your confidence level 0 to 100 and your target stock price on the underlying asset, it'll give you a little pointer which you want to fall within the windows to help you choose the right option there. So I know you mentioned a little bit about that, and we've developed a little bit of a software, and that's kind of where the future is going here, is that because options isn't necessarily just about winning trades, it's about exposure and also your confidence in certain trades and your weighting, because not everybody, for example, Oliver is going in with the same amount of capital into each trade. He might take a losing trade and a winning trade, but with the losing trade, he only had $200 of exposure, and on the winning trade, he had $800 of exposure. So, this is all very important things with trading and stuff like that. So,
I would. I don't mean to interrupt you there. I was just going to say, I would encourage people to check out a guy named Blair Hull. He was a guy who ran this thing called Hull Trading, which was an advanced type trading firm. He sold the firm to Goldman Sachs for like $5 zillion at one point, but I guess I can write it in the chat. But he has some of those really big computers that you're talking about at the New York Stock Exchange that are crunching numbers really quickly. And a lot of that has to do with the stock trading, and they're seeing orders come in. You want to see an order come in, like a market order come in ahead of everybody else, and because you can get to that order first. A lot of it is about that. But check out Blair Hull. He has a chat with traders. It's this Australian guy who does a lot of trader interviews. has a good interview with him, and he does a lot of this computer learning stuff, and he talks about it and explains it in a much better way than I can. Thank you. I just want to thank you guys for the opportunity to come on here. If you guys, if people have a chance, I would just ask, just subscribe to my YouTube channel. All those
we
things.
put the link in the chat.
I saw that.
Yeah, no, please,
subscribe,
guys, please go support
say
David.
hi. Yeah, just leave a comment, say hi. You've heard all those normal YouTube things. I don't need to say them all again.